Decoding the fractal algorithm. Most retail traders live on the 15-minute chart. They draw order blocks. They mark fair value gaps. They wait for the perfect entry. Price taps the zone. And then, stop loss. But the market didn't randomly disrespect your analysis. In reality, many of these retail setups exist for one purpose: liquidity. Retail stop losses become the fuel institutions need to move price toward a higher time frame objective. Most retail traders live on the 15-minute chart. They draw order blocks. They mark fair value gaps. They wait for the perfect entry. Price taps the zone. And then, stop loss. But the market didn't randomly disrespect your analysis. In reality, many of these retail setups exist for one purpose: liquidity. Retail stop losses become the fuel institutions need to move price toward a higher time frame objective. In other words, the market isn't hunting you personally. It's simply collecting the fuel required for the next move. The market operates on four core principles. Think of them as the pillars holding up the entire structure of price. Pillar 1, fractal nature, the foundation. Patterns repeat across all time frames. Pillar 2, market structure, the framework. Higher highs, lower lows, expansions and pullbacks. Pillar 3, liquidity, the mortar. Stop losses, breakout traders, and trap positions. Pillar 4, true bias, the walls. The directional objective driving price. Remove the fractal nature and everything collapses into noise. Because the market is not just one chart, it's a layered system of repeating patterns. Fractals exist everywhere in nature. Ocean waves, river currents, even the branches of a tree. A small ripple mirrors the shape of the larger wave. And the same rule applies to financial markets. The micro movement inside a 1-minute chart is simply a smaller version of the macro move happening on the daily or weekly chart. But here's the critical rule. The microwave can never override the macro wave. It only exists inside it. To understand the market, you must understand time frame hierarchy. Each time frame has a different role. Weekly and daily charts set the destination. They define the macro objective. 4-hour and 1-hour charts hunt liquidity. They create pullbacks, traps, and manipulation. 15-minute, 5-minute, and 1-minute charts handle execution. They build the small structures that eventually get broken to fuel the larger move. In other words, lower time frames don't control the market. They serve the higher ones. Part 5. Why your 5-minute order block fails. Imagine placing a tiny barricade in front of a bulldozer. That's what a 5-minute order block looks like when the daily time frame has a different objective. If the weekly chart needs to reach a certain level, the daily chart will push price there. And along the way, every small structure in its path will be crushed. The market owes zero respect to a micro setup standing in the path of a macro objective. Part 6. The time frame engine. Price moves through a continuous engine loop. Lower time frames exhaust themselves to build setups for higher time frames. 1-minute structures break to create 15-minute points of interest. 15-minute structures break to create 1-hour and 4-hour fuel. The 4-hour chart then builds a daily order block, and the daily chart fulfills the weekly objective. Once the weekly objective is complete, the cycle starts again. Part 7. Redefining true bias. Retail traders think bias means price should bounce here. But real market bias works differently. Institutions don't predict bounces. They seek liquidity. The market moves from one pool of stop losses to another. Your stop loss is often the exact order needed to fill a large institutional trade. For big money to buy, someone must sell, and retail stop losses provide that supply. Part 8. The liquidity fuel model. Here's how the engine really works. First, the market tempts traders into positions. Buyers enter. Stop losses stack below the lows. Then suddenly, price spikes down. Retail traders panic as their stops are triggered. But those stop losses are not wasted. They become the sell orders required for institutions to buy massive positions. Once those orders are filled, price accelerates upward, not randomly, but by design. Most traders stare at the 5-minute chart, trying to solve the market like a puzzle. But focusing on one piece of the puzzle will never reveal the full picture. The market is a fractal machine, a system where lower time frames feed higher time frames, and liquidity powers every move. Once you stop trading the small waves and start understanding the entire ocean, the market begins to make sense.